What is going on, YouTube? Welcome back to Death and Taxes, a channel focused on all things finance. Today I'm going to be talking about the bear market and about Tina. So let's just jump in. So right now there's a lot of people talking about when are we going to get a bounce? When are we going to get a bounce off the S&P, the NASDAQ, etc. Crypto with Bitcoin as well. People are wondering, when are we going to finally see a bounce, right? And I've seen a lot of channels and content talking about the possibility of going on a strong run here. And look, we're in a bear market, okay? I know some people aren't really willing to admit that, but fundamentally, our market conditions are pointing to being in a bear market. I mean, look at this trend. You can't look at this and tell me that that's a bull market. It's not. So what I've done here is I've got the NASDAQ pulled up, the triple Qs, and I'm using Heiken Ashi candles because these help identify trends, okay? So the way that Heiken Ashi candles work is when calculating the quote unquote open and close of the candle, it actually uses a weighted average of the high, the low, the open, and the close versus just purely the time periods open and close. So it gives you I guess, a stronger view of the direction that the market is moving. And typically when you see strong red candles like this, big red candles with wicks all to the downside, that's indicative of a downtrend. The reverse is true on an uptrend. You have big green candles with wicks to the upside. It means that there's price momentum pushing upwards, whereas when the wicks are going down, you have price momentum pushing downwards on the market. So that's really the situation that we're in right now. And one thing I want to mention is it's certainly possible. I mean, we're getting to the bottom of this channel here. You know, I really hate drawing arbitrary lines like this, but we're kind of getting to the bottom of this channel here. There's a lot of really bearish sentiment in the market right now. Some metrics are showing that the NASDAQ and growth stocks in particular are oversold. So I wouldn't be shocked to see a short-term bounce, back up a little bit. But really in the long run here, I mean, or the medium term rather, we're in a downtrend, especially for risk on assets, right? So if you look at the ARK ETF, I mean, it's down even more from its all-time high. It's down literally 73% from its all-time high. That's crazy. So the really high growth end of the market has just taken an absolute beating. I mean, we're almost at 2020 lows. We're almost at March 2020 lows on the ARK. So generally the way that these trends go is you kind of get a leading pattern from the most speculative end of the market. And a lot of the growth and innovation stocks that are in the ARK ETF are some of the most speculative, risky bets in the market. So when this starts to go down, it generally leads the rest of the market. And then the NASDAQ being so tech heavy also tends to underperform the market and lead the market when patterns are reversing, right? So we're seeing the reversal with a lot of risk on assets taking a huge beating, cryptocurrency included in that, just a massive macro downtrend. I mean, this bear market has taken 56% of the value of Bitcoin away. So, I mean, there's no way that you can look at that and tell me that that's a bull market, that's not a bear market, because it is. So a lot of the risk on assets are leading the market downwards. We're in a inflationary period where a lot of investors are wondering, where do I put my money? Because for the longest time, they've been adhering to this idea of Tina, there is no alternative. So for decades, investors have basically said there is no alternative to stocks. Stocks are the only investment that provides value, significant value in the long term, because bond yields are low. Cryptocurrencies weren't really mainstream yet. And frankly, where else are you going to put your money? So that pattern is starting to shift. Look at what's going on in our risk on equities. I mean, even the market generally, the S&P 500 still is down over 15%. from its all-time high. So look, we're in an environment where maybe there are some alternatives, and really there's two notable ones that I found and that I've been watching closely. So the first is the bond market. So the yield on 10-year Treasury notes has been in a really strong uptrend for a while now, since 2020. And generally, the bond market historically has had really low yields for decades. This is starting to shift. So the 10-year tends to follow the Fed in terms of what they do. So if the Fed is raising rates, generally the 10-year goes in the same direction. Not always, but for the most part. And this is the interest rate that the market uses for everything else, for mortgage rates, for interest rates that businesses charge each other. All kinds of corporate bond and commercial bonds are based off of this risk-free rate, is what it's called. So the risk-free rate is already over 3%. And been reading a lot, investors, as soon as this thing gets moving like this, well over 3%, if it keeps going higher into the 4 or the 5% range, that's actually a sizable return on a completely risk-free investment. The odds that the government would default on its debt are very low, so this is generally considered risk-free. So if you can get, a 3, 4, 5% return on your money for absolutely no risk, why would you not do that? Especially when all of your stocks, cryptocurrencies, etc., are losing this much value this quickly. So a lot of investors might start to look at this. And now you might say, okay, Frank, like bond prices are down 10% on the year. That's true. That's true. But generally, investors follow yield on bonds. Price changes make very little in terms of the portion of the return that you ultimately make on bonds. Over 90% of the return you make on bonds comes from the interest rate itself. So as this continues to go higher, I would watch a lot of investors start to shift money into the bond market. That's going to further take away equity from the stock market, could continue putting downward pressure on that because now, there are starting to be some alternatives. A lot of investors like to wait until the interest rates really start to roll over and peak before they start buying up bonds to avoid downward pressure on the price. But we'll see, and we'll see when the Fed decides that they're going to pivot. So I would be watching this and watching for, a shift in what's going on in the 10-year. I would also be watching for a shift on what's going on in the dollar. So the US is really having a strong macroeconomic picture, at least relative to the rest of the world. China's locked down. Europe is in chaos with the energy crisis and the war. And so the dollar is really on a roll here. And so I would watch for the dollar to start to shift too, which could allow room for some of these risk-on assets like your ARK stocks, like Bitcoin, to start to rally. So I would just be waiting and holding cash, again, not financial advice or anything, but holding cash and waiting for when the 10-year and the dollar start to roll over. We're just in a downtrend. I think it's very possible we get a small bounce here, but I would not count on that, especially with more inflation data coming out this month. Who knows? We'll be breaking that down in future videos, so stay tuned for that. If you like the content of today's video, please smash that like button, smash that subscribe button. It really helps us out a lot. Thank you for watching.